So you're thinking about buying a home for yourself, and that might be right now, that might be in a couple months, that might be a couple years away. But at whatever point that happens, when you do your research, you're going to find out that the first step is very commonly to go get a pre-approval. Now, for someone who has never bought a home before, how do you even know if you're ready to take that first step, right? What does that actually look like? What do you need to know before you jump into that first step? So that's exactly what we're going to get into in this video. So let's get right into it. The first thing that you need to check in order to understand if you might be ready for a mortgage pre-approval is to understand what your credit score currently is. And if you're currently sitting there lower, what's a credit score? Well, a credit score is simply a number that predicts the likelihood that you're going to pay back the money that you're borrowing, whether through a loan or through a line of credit, right? And so the higher this number, the better for you. And of course, the interest rate that you're going to get on a mortgage loan. So a perfect credit score, just so you know, is 850. So conventional loans, those typically we like to say if you have a 680 or higher, that's kind of where the conventional loan would start. And then if you have at least a 580, we typically like to see 580. And, you know, you could actually get an FHA loan with a 500 credit score. However, that's going to require 10% down. So that's why we prefer to see the 580 versus a 500. Now, if your credit score is lower than this, there are ways that you can build your credit up. So if you're not really trying to buy a home too quickly, then you can work on improving your credit score, right? And so that might be things like paying your loans, paying your credit cards on time. Stop missing payments, right? Other things are that if you're carrying too much credit card debt or your loans are maxed out or whatever, you got to work on paying those now, right? So again, if you miss payments, if you skip payments, right, that's really going to hurt your credit score. So don't do that. Sometimes it's a matter of how long have you had those credits as well, right? So if you have credit cards already, just because you're working on paying them off, don't go closing them, because that can hurt your credit score too, okay? You should at least keep them open so that it can build your history of credit. So hopefully that helps you understand that a little bit better. Now, as far as how do you go about checking what your credit score is? Well, today, if you have a bank, right, a bank account, most major banks, they have a way for consumers to check, to monitor what their credit score is. And so that might be as simply logging into your bank account, whether that's through your computer, through the website, or on a phone app. So they usually have ways that you can monitor your credit score nowadays. Now, if your bank account or your credit card doesn't offer that capability, you could go to other websites like creditkarma.com or even annualcreditreport.com to pull your annual report. Something to note is that websites like Credit Karma or even through your app, the way that they generate and they calculate your credit score, it may not exactly match up with what we use when we're checking your credit score. So we actually pull your credit through 3 of the most common credit bureaus out there. So we pull it from Equifax and TransUnion and Experian. And typically for the mortgage side, we only go with the middle credit score, which works in your benefit because sometimes for some reason, one of the 3 might be significantly much lower than the other 2. So that's something very important to keep in mind, that, what you're seeing in your phone app or Credit Karma is just a rough number for your credit score. So, and that's really all you need to know is that, hey, where do you stand? Are you, higher than 580? Are you 700s, 800s, right? So that should give you an idea of what you need to know if you're ready to take that first step to get pre-approved. Now, let's move on to the second step. The next item that you're going to need to be able to confirm is that you have income coming in and at least a minimum of 2 years history. So meaning that if you are an employee for a company, you have to show that you have at least 2 years of W-2s. Now, This work history doesn't necessarily mean that there has to be consecutive years of work history. It could mean that potentially you either switched jobs or you had a break in between for some type of valid reason, right? So like layoffs or medical reason, we could consider that gap as long as you're still in the same work-related field. Now, at the same time, if you are a student that recently graduated, right, we could count your time in school towards that work history requirement as long as your current job is related to your degree. Now, if you are a self-employed individual or you own your own business, you must show that your business has been operating for at least 2 years, and you will also have to present 2 years of tax returns. One and very important note is that if you are taking too many write-offs and expenses out of your business's income, we only pre-qualify you based on your reported net income. So taking too many write-offs can definitely hurt your pre-approval amount. The next thing is for you to double check to make sure that you have enough funds in order to buy a home. Makes sense, right? So you will have to check not only your savings account, your checking account, but also your other assets that might be available to you. So just because you don't have enough money in the bank, there are other places that you could pull this money from. And that might be places like your 401k or your retirement savings plan, right? Or potentially also if you have a life insurance with cash value, you could borrow from that. So there are some places where you could pull capital from. If you are a stock investor, you have stocks, you could potentially borrow from your stocks or sell the stocks, right? Or if you have other valuable assets that you can sell, like collectibles, cars, even Pokemon cards. These days are very valuable, apparently. Something very important to note is that do not just make very large cash deposits into your bank account, because this could raise red flags for you, especially if you don't have any way to trace where that money came from. It doesn't matter if it's been sitting on your mattress for years and you just all of a sudden wanted to put it in the bank. Well, the lender is going to want to see a paper source. And so typically when you do these types of large cash deposits, they require that that money sits in your account for at least 2 months for it to season. Now, some other important things is how much money do you actually need to have saved up? Well, if you're going to purchase using an FHA loan, the minimum down payment is 3.5% of the purchase price. And if you are going to use a conventional loan, that down payment is typically 5% minimum down payment, although sometimes there are 3% first-time homebuyer conventional loans out there available as well. Now, the down payment is only just one portion. There is also the closing costs involved. So that could be things like lender closing costs, title closing costs, inspection fees, appraisal fees, insurance for the home. So these things add up, right? So to put together a total rough estimate for you, you'd probably need the down payment plus the closing costs, and we would estimate the closing costs to be anywhere from potentially 4% to 5%. It really depends where you live, how much insurance costs where you live, as well as property taxes, because they do collect some funds up front to fund your escrow for the property taxes and the home insurance as well, and those are all a part of your closing costs. So it can add up pretty significantly. I would say for a rough estimate, to determine your funds available that you would need, I would go anywhere from 6% to 10% of the purchase price. So you should have that saved up, right? So whatever kind of home budget you're planning on, right? The type of home that you want to buy, estimate 6 to 10%, right? The higher, the more conservative, the better. At least you know for sure that you'll be good to go. The next item of order for you to determine if you might be ready for a mortgage pre-approval is to estimate what your DTI or your debt to income ratio is. And so this is just a fancy term to say all of your total major recurring debts every month divided by your total gross income. So very important, gross income before taxes. So what we're going to do here is we're going to add up all of your recurring monthly major debts. So things like student loans, personal loans, credit card, right? Alimony, child support, right? Stuff that you're paying regularly for a long term, right? We're going to divide that by your total gross monthly income. And, you know, for the debts, we don't care about the small stuff like your phone bill, your internet bill, utility bills, even your rent, because your rent should not be a factor anymore once you buy that house. So what we're going to do is we're going to divide all those debts, right? And right now, we're not including the cost of that new house, right? We're not including the cost of the mortgage at this point. So you want to keep this DTI ratio without the cost of that new mortgage. You want to keep that super low. The lower, the better, right? That means that you have more room, more budget to buy a home, essentially is what that means. So ideally, I mean, if you're not even adding in the cost of that new mortgage yet, ideally you might want that DTI to be around 25%, 30% at most. If it's more than 30%, then you may not have enough room to buy a house in your area, right? So let's put some numbers on it to give you some example here. So let's say that you make $10,000 gross income per month, right? So we add up all your debts, your recurring debts every month, and you're pretty good. You're well behaved. You have only $1,000 of recurring debt every month. Okay, so that's pretty good. So what that means is that right now, without adding your future mortgage, you're sitting at 10% debt to income ratio. So you have a lot of runway to work with on that home mortgage, right? And when we do add in that mortgage, typically what we like to keep that limit at is roughly anywhere between 45 to 50% DTI. That's kind of where we like to keep it, and it really depends on the type of loan program that you're going to use, what that limit becomes. But so in our current example, if you're sitting at 10% DTI, that pretty much means that, hey, you know what, if we take it all the way up to 50% DTI, you have about $4,000 a month that you could use towards a house, right? So that would also include not just the principal and interest of that mortgage, but it also factors in the taxes and the insurance as well. So that's very important to note, because depending on what county, what city, right, your taxes could be very different, right? You know that best wherever you live. And same thing with insurance. I mean, depending on what state, what city, right, what natural disasters are around you, your home insurance could be pretty affordable to very expensive, right? So those are things that you need to factor in to give you a rough idea. And so again, if you want to estimate your DTI without even, bothering about the mortgage factor part of it, keep that DTI about 25%, 30% and below. Okay, that's what I would say for you. And so if you can do that, then you might be ready for that pre-approval process. Okay, so that completes all the things that you will need to check about your own personal financial situation to do a rough analysis if you might be ready to apply for that mortgage pre-approval. Let's do a final recap. Here's how to determine if you might be ready for that mortgage pre-approval. Number one, check your credit score. If you're going to go FHA, ideally you want to be 580 or higher. If you're going to go conventional, ideally you want to be in the 700s or higher. Number two, make sure that your income is qualifying, meaning that if you're a W-2 employee, you have a minimum 2 years of work history. If you are self-employed or you own your own business, your business should be operating for more than 2 years, as well as have 2 years of tax returns. Number three, qualifying funds. Make sure you have the funds available to buy that home. Not only are you concerned about the minimum down payment, which FHA is 3.5% or conventional 5%, but you want to have an additional 4 to 6% to cover the closing costs. Now, besides your savings account and your piggy bank, other places that you could look for funding is potentially your 401k, your IRA, or your stocks, car collection, or maybe even your Pokemon collection. Number four, check your DTI or your debt to income ratio. This is the total of all your major monthly debts divided by your gross monthly income. And the debt should also include that future mortgage payment that you're going to take on. So if that is under 50%, you're all set. So there you have it. That's all the information you need to determine if you might be ready to apply for that mortgage pre-approval. You can go through the process yourself, or you can reach out to me, Laura Vang, with Nexit Lending. I'm licensed in the states of California, Wisconsin, and Minnesota. And so if you have any unique questions, scenarios that you want to run by me, or you just want me to do the work for you, feel free to give me a call. Let's set up a time to talk. That's it for this video. If you got some value out of it, please do me a huge favor, hit that like, share it, and get it out to people who need to see it. Thank you so much for watching. I'll see you in the next video.